Hi everyone, it's Julius and welcome back to the channel. So are you thinking of investing in the stock market but you are still holding back because you're scared? Now the hardest part about investing is actually to beginning the process. Now once you begin putting your money to work, you're going to realize it's an easy process. You're going to hear a lot of people discouraging you because they either failed or they don't know what they're talking about. Now you see, people are always intimidated by what they don't know, rather than trying to educate themselves on what they don't know. Other people are always looking for an easy way out rather than working on a strategy that is going to work for them. Now while some people may get lucky and buy a winning stock, that may not always be the case. Actually, in fact, in most cases, that's unlikely to happen. Now, as an aspiring investor, you need to understand what's most important in stock investing. Most investors, as we pursue success in the stock market, we often overlook the most powerful tool available, and that is timing the market and the magic of compound interest. Investing regularly, avoiding unnecessary financial risk, and letting your money work for you over a period of years and decades is a certain way to grow your portfolio. Now in this video we are going to look at 4 tips that's going to help you as a beginning investor. The first tip is setting long-term goals. Now you need to ask yourself questions like, why are you considering investing in the stock market? Will you need your cash back in 6 months, a year, 5 years or longer? Are you saving for retirement, for future college expenses, or to build an estate to leave to your beneficiaries? You see, before investing, you should know your purpose and the likely time in the future you may have the need for the money you're investing. Now, if you're likely to need your investment returned within a few years, consider another investment, because the stock market with this volatility provides no certainty that all of your capital will be available when you need it. Now, by knowing how much capital you will need and the future point in time when you will need it, you can calculate how much you should invest and what kind of return on your investment will be needed to produce the desired results. Now remember that the growth of your portfolio depends upon 3 independent factors. And that is the capital you invest, the amount of net annual earnings on your capital, and then the number of years or period of your investments. Tip number 2, you need to understand your risk tolerance. Your risk tolerance is how you feel about risk and the degree of anxiety you feel when the risk is present. Now, in psychological terms, risk tolerance is defined as the extent to which a person chooses to risk experiencing a less favorable outcome in the pursuit of a more favorable outcome. In other words, would you risk $100 to win $1,000, or would you risk $1,000 to win $10,000? All humans value their risk tolerance, and there is no right balance. Now, risk tolerance is also affected by one's perception of the risk. Now you see, the idea of perception is important, especially in investing. Now as you gain more knowledge about investments, for example, how stocks are bought and sold, how much price change is usually present, and the difficulty or ease of selling an investment. Now by understanding your risk tolerance, you can avoid those investments which are likely to make you anxious. Now generally speaking, you should never own an asset that keeps you awake or have sleepless nights. Tip number 3 is diversify your investments. Most experienced investors like Warren Buffett choose stock diversification in the confidence that they have performed all of their necessary research to identify their risk. Now the best way I believe to manage risk and end those sleepless nights is to diversify your exposure. So most successful investors that I follow own stocks of different companies in different industries or sectors, sometimes in different countries. with the expectation that a single bad event will not affect all of their holdings, will otherwise affect them in a different degree. Now, imagining owning stocks in 5 different companies, each of which expect to continually grow profits. Unfortunately, circumstances change. At the end of the year, you might have company A and B that have performed well, so their stocks are up by 25%. Now, the stocks in C and D in a different industry are up by 10%. While the 5th company, that's company E, assets were sold to pay off a massive lawsuit. Now, you can see how diversification allows you to recover from the loss of your total investments if you had only invested in company E. Tip number 4, you need to control your emotions. You see, the biggest obstacle to stock market profits is an inability to control one's emotions and make logical decisions. In the short term, the prices of companies reflect the combined emotions of the entire investment community. When a majority of investors are worried about a company, its stock price is likely to decline. And when a majority feel positive about the company, its stock price tends to rise. Now, if you have been in the stock market, I'm pretty sure you have heard of terms like the bear market or the bull market being used interchangeably. Now, a person who feels negative about the market is called a bear. Now, while the person who feels positive about the market is referred to as a bull. Now, during market hours, the constant battle between the bulls and the bears is reflected in the constantly changing price of securities. And these short-term movements are driven by rumors and speculations and emotions rather than logic. And this is when you're going to find people asking themselves questions like, should I sell my position and avoid a loss? Should I keep the stock hoping that the price will rebound? Should I buy more? Even when the stock price has performed as expected, you're going to find people asking the same questions. Should I take a profit now before the price falls? Should I keep my position since the price is likely to go higher? Thoughts like these will flood your mind, especially if you're constantly watching the price of securities on the news or social media. Now, eventually building to a point that you are going to take action. And since emotions are the primary driver of your action, it will probably be wrong. That's why you need to do your own research rather than buying a stock because someone else is recommending it. Now, when you buy a stock, you should have a good reason for doing so and an expectation for what the price will do if the reason is valid. Now, at some point, you should establish the point at which you will sell your holdings, especially if your reason is proven invalid or if the stock doesn't react as expected when your expectation has been met. Now, in other words, have an exit strategy before you buy the stock. Investing in the stock market is a great opportunity to build wealth, but you need to come up with a strategy that works for you. Educate yourself through reading books and watching videos of other investors. Now, always remember, timing the market is always better than timing the market. And this is going to help you greatly when it comes to compounding. Now, the younger you begin your investing journey, the greater the final results. Just remember to walk before you run. I hope this video is useful to anyone out there who is thinking of putting their money to work. Do not forget to use the link in the description below where we can both get a free stock. On the other hand, if you don't feel like using my link, you can get a friend who's on the same page as you. And both of you can open up an account with Robinhood and can get a free stock. Don't forget to give this video a thumbs up and consider subscribing to join the journey. See you in my next video.